They tell you it's a meritocracy. That if you work hard, save responsibly, and make good choices, the system will reward you. And if you're still struggling, the story goes, it must be something personal, your discipline, your mindset, your habits. But the numbers don't behave like a morality tale. They behave like engineering. Look at what has happened to wealth at the very top. Federal Reserve data tracking household net worth since the late 1980s shows a country where ownership has become increasingly concentrated. The top 1% holds roughly around a third of total household wealth in recent readings, while the bottom half holds only a small sliver. A separate Congressional Budget Office analysis similarly documents rising concentration of wealth over the last few decades. That doesn't happen because an entire class of people suddenly became more virtuous. It happens when the rules consistently pay more for owning than for working. Now zoom in on the most quietly violent mechanism in modern life: the gap between productivity and pay. The Economic Policy Institute's long-running work shows that, since the late 1970s, the typical worker's compensation has risen far more slowly than the value that worker produces. In other words, we got better at generating wealth, but we didn't get proportionally better at receiving it. The extra value didn't vanish. It was captured upward by those who already owned the assets, the equity, the claims on future cash flows. And that's the first uncomfortable clue that this is not an accident. Because the system doesn't simply reward effort, it rewards position. If you own assets, you benefit when money flows into financial markets and prices rise. If you own only your labor, you are paid in a currency that competes against inflation, rent, healthcare, and debt interest costs that do not politely wait for your next raise. The same pattern shows up in executive pay. Over the decades, CEO compensation has become dramatically detached from the pay of typical workers, a shift strongly associated with equity-based compensation and the financialization of corporate incentives. That isn't just a cultural choice inside boardrooms. It's a signal flare. The system is optimized to funnel gains toward those closest to ownership and control. So tonight, we're going to stop treating inequality like a mystery and start treating it like a machine. A machine with inputs, levers, and predictable outputs. Once you see the mechanism clearly, the real question changes from, why am I falling behind? To something far more dangerous. Who benefits from me believing it's my fault? Is a stiltone. To understand why this system works the way it does today, you have to rewind to a moment most people never connect to: their own paychecks. It doesn't begin with billionaires or Wall Street bonuses. It begins with a structural break in how money itself was allowed to behave. In the early 1970s, the United States severed the dollar's final link to gold. Officially, this was framed as a technical necessity, a response to trade imbalances and mounting pressure on reserves. In reality, it was something much larger. For the first time, the world's dominant currency was no longer constrained by a physical anchor. Money could now be created in virtually unlimited quantities, limited not by gold in a vault, but by political and financial decisions. At first, this looked like flexibility. Governments could respond to recessions faster. Financial markets could be stabilized during shocks. But flexibility came with a side effect that would reshape society. Where new money entered the system mattered more than how much was created. And that entry point was not wages. New money flowed first into banks, capital markets, and large institutions. From there, it inflated the prices of financial assets, stocks, bonds, real estate long before it ever reached workers' paychecks. This dynamic is not theoretical. It has played out repeatedly over decades. Asset prices rose far faster than wages, not because houses suddenly became more useful, or companies suddenly became more productive, but because liquidity was designed to pass through ownership channels first. This is where the split between labor and capital became structural rather than accidental. If you owned assets when this system accelerated, you benefited from compounding price appreciation. If you did not, you were paid in wages that lagged behind rising costs. Productivity gains continued, but the rewards were rerouted. The economy became better at producing value while becoming worse at distributing it. By the late 1970s and early 1980s, policy choices locked this in. Tax structures shifted away from high marginal rates on top incomes and toward lower taxes on capital gains. Financial deregulation expanded leverage and speculation. Labor protections weakened. Unions lost bargaining power. Globalization allowed corporations to arbitrage labor across borders, suppressing wages at home while boosting profits abroad. None of these moves happened in isolation. Together, they rewired the incentive system. What's critical to understand is that this was not sold as a wealth transfer. It was sold as efficiency, as modernization, as growth. And growth did happen, but it flowed unevenly. The system began to reward proximity to capital rather than contribution through work. Ownership became the primary engine of upward mobility, while labor income became increasingly defensive, focused on keeping up rather than getting ahead. This historical shift explains why inequality today feels so stubborn. It's not driven by a single bad policy or a handful of greedy individuals. It's embedded in the operating logic of the economy. When crises hit, liquidity injections protect asset prices. When inflation rises, wages chase it from behind. When debt expands, cheap credit is reserved for those with collateral, while everyone else pays a premium simply to function. By the time people notice the outcome, the cause is already decades old. The ladder didn't disappear overnight. It was quietly tilted. And once tilted, every step upward required more effort from those at the bottom and less from those already near the top. Understanding this historical trigger matters because it reframes the present. If the system was redesigned, then struggling within it is not a personal failure. It's the predictable result of rules that reward ownership, leverage, and access long before they reward effort. Once the rules changed, the system didn't rely on one lever. It relied on a set of mechanisms that reinforce each other, quietly and relentlessly. None of them require conspiracy. They function because they are mathematically and institutionally aligned. Start with asset inflation versus wage income. When liquidity enters the economy through financial channels, it raises the price of things that can be owned and traded. Stocks reprice first. Real estate follows. Private equity valuations adjust. Wages do not. Wages are negotiated slowly, constrained by contracts, competition for jobs, and the constant threat of outsourcing or automation. The result is a permanent lag. Even when wages rise, they chase prices that already moved. This gap creates the first lock-in. If you own assets, inflation works for you. If you don't, inflation is a tax you cannot escape. The system doesn't need to suppress wages explicitly. It only needs to allow asset prices to run ahead. Over time, the difference compounds into a widening ownership divide. Next comes credit access. Credit is not distributed based on need. It is distributed based on collateral. Those who already own appreciating assets can borrow at low interest rates, often below inflation. That means borrowing itself becomes profitable. You can leverage an asset, watch it rise faster than the cost of debt, and capture the spread. This is how debt turns from a burden into a tool. For those without assets, credit works in reverse. Interest rates are higher, terms are punitive, and loans are often used for consumption rather than investment. The math is unforgiving. High-interest debt compounds against you, while low-interest debt compounds for those at the top. The same financial instrument produces opposite outcomes depending on where you start. Then, there is taxation. Labor is visible. It cannot hide. It is taxed at the source. Capital is flexible. It can move, defer, reclassify, and borrow against itself. Income from work is taxed annually. Gains from assets are taxed later, often at lower rates, and sometimes not at all if they are never realized. Borrowed money is not income. Inheritance rules reset the clock. Over generations, this allows large pools of wealth to pass through time, with minimal friction. Layer onto this corporate incentives. Executive compensation increasingly arrives in the form of equity. When asset prices rise, executives win, regardless of whether wages keep pace. Share buybacks prioritize price appreciation over long-term wage growth. Cost-cutting boosts margins. Margins boost stock prices, and stock prices determine who is rewarded. Labor becomes an expense to be managed, not a partner in value creation. Finally, add crisis response. When systems break, authorities intervene to stabilize markets. Liquidity is injected to prevent collapse. Asset prices are protected first, because financial stability depends on them. Jobs recover later, if at all. Each crisis resets the baseline higher for asset owners, while leaving workers to rebuild from losses. What looks like emergency management becomes a recurring transfer mechanism. Put together, these components form a closed loop. Asset ownership grants access to cheap credit. Cheap credit accelerates asset accumulation. Favorable tax treatment preserves gains. Crises protect the top of the system. Wages, meanwhile, remain linear, taxed, and exposed to inflation. The machine does not need intent. It runs because every part reinforces the others. This is why effort alone cannot close the gap. You are not competing against other workers. You are competing against compounding structures designed to reward ownership, leverage, and time. Until that is understood, inequality will always be explained as a personal problem instead of what it really is, a structural outcome. Once the machine is running, the outcome stops being ambiguous. The system does not merely create inequality, it assigns roles. There are those positioned to extract value, and those positioned to supply it. Over time, that division hardens into dependency. The winners are not defined by effort. They are defined by proximity to ownership. If you own assets, the system feeds you first. Rising asset prices expand your balance sheet. That expanded balance sheet becomes collateral. Collateral unlocks cheap credit. Cheap credit allows further acquisition. Each cycle strengthens the next. Wealth, in this structure, becomes self-reinforcing. But the most important advantage is not money itself. It is optionality. Asset owners can wait. They can defer taxes. They can ride out downturns. They can shift capital across borders and instruments. Time works in their favor because compounding rewards patience when you start with capital. For everyone else, the experience is fundamentally different. If your income comes primarily from labor, your relationship to the system is fragile. You are paid in intervals. Your expenses are continuous. Housing, healthcare, education, and transportation do not pause when wages stagnate. Debt fills the gap, and once debt enters the picture, dependency deepens. High-cost debt does more than extract interest. It narrows choices. It limits mobility. It forces short-term decisions in a system optimized for long-term compounding. A household burdened by expensive credit cannot wait for opportunity. It must service obligations first. That is how dependence becomes structural rather than situational. This is where the system becomes political without appearing so. When a large portion of the population lives close to the edge, risk-taking declines. Organizing declines. Resistance declines. People become focused on survival rather than leverage. Meanwhile, those at the top use accumulated wealth to shape policy, influence regulation, and protect the mechanisms that benefit them, not through overt control, but through persistent alignment of incentives. Dependency also scales upward to nations. Countries without reserve currencies borrow in currencies they do not control. They service debt through exports and austerity. Inflation and interest rate shifts decided elsewhere ripple through their economies. Sovereignty erodes not through invasion, but through balance sheets. The same logic applies. Those who control capital set the terms. What emerges is a hierarchy disguised as a market. At the top, capital circulates among owners, compounding quietly. In the middle, households juggle wages and debt, hoping stability holds. At the bottom, precarity becomes permanent. Movement between layers is possible, but statistically rare, because the system is not designed to lift broadly. It is designed to concentrate efficiently. This is why inequality persists even during growth. Growth does not distribute itself. It follows channels. And those channels were built to favor ownership over participation. The winners are not villains in a moral sense. They are beneficiaries of design. The losers are not failures. They are inputs. Understanding this distinction matters because it shifts the question again. The issue is no longer who deserves what. The issue is how dependency is engineered, maintained, and normalized, and why so many people are told it reflects personal worth rather than structural position. If you ever want to see what a system truly values, don't watch it during calm periods. Watch it under stress. Crises strip away the language, the narratives, the moral framing, and expose the priority stack underneath. And in the modern financial system, every major crisis has acted less like a shock and more like an accelerator. Start with what happens when something breaks. Markets seize up, credit freezes, asset prices wobble. At that moment, governments and central banks intervene, not because they favor the wealthy in theory, but because they fear systemic collapse in practice. Financial markets are treated as critical infrastructure. If they fail, everything else follows. So liquidity is injected fast, at scale, and through institutions that already sit closest to capital. This is the key asymmetry. Emergency money does not enter the economy evenly. It enters through banks, bond markets, and large financial actors first. From there, it stabilizes asset prices. Stocks recover. Real estate rebounds. Corporate balance sheets are repaired. Only later, if at all, does relief reach wages, employment, or household balance sheets. The effect is consistent. Losses are socialized downward, while recoveries are privatized upward. Take the global financial crisis. Millions lost homes, jobs, and savings. Entire neighborhoods were hollowed out, yet large financial institutions were rescued. Cheap money allowed capital to buy distressed assets at fire sale prices. Ownership consolidated. By the time employment recovered, asset prices had already surged past their pre-crisis levels. The people who could afford to wait were rewarded. The people who were forced to sell, locked in losses. The pandemic followed the same logic, at unprecedented speed. Trillions were created to prevent collapse. Some relief reached households, but the overwhelming force of liquidity went into financial markets. Equity prices rebounded within months. By the end of the year, asset owners were richer than before the crisis began. Meanwhile, small businesses closed permanently. Labor participation dropped, and inflation quietly began eroding purchasing power. This is not corruption. It is design interacting with urgency. When policymakers face a choice between stabilizing markets or letting them fail, they choose stabilization. But because markets are owned, not shared, stabilization protects owners first. Crises also reshape debt. During downturns, households borrow to survive. Governments borrow to intervene. Corporations borrow to refinance. But the cost of borrowing is not equal. Those with collateral refinance cheaply. Those without it face higher rates, tighter terms, or no access at all. The balance sheet divide widens precisely when people are most vulnerable. Inflation then completes the transfer. After liquidity floods the system, prices rise. Assets reprice upward, wages lag, savings lose value. Debt denominated in nominal terms becomes easier to service for those with assets and harder for those without buffers. What began as an emergency response turns into a slow redistribution through purchasing power. Over time, crises stop being exceptions. They become features. Each one resets the starting line higher for asset owners and lower for everyone else. The system doesn't need constant growth to concentrate wealth. It only needs periodic stress. This is why the promise that the next recovery will lift everyone keeps failing. Recoveries lift what is closest to money first. They lift balance sheets before paychecks. They lift ownership before participation. By the time gains trickle outward, much of the advantage has already been locked in. And here is the most uncomfortable implication. If crises transfer wealth upward, then instability becomes profitable for those positioned correctly. Volatility is not feared at the top. It is managed, hedged, and often exploited. For those living paycheck to paycheck, instability is existential. For those with capital, it is opportunity. This creates a perverse incentive landscape. A system that claims to reward stability increasingly depends on disruption to reinforce its hierarchy. Not because anyone explicitly planned it that way, but because every intervention reinforces the same channels of protection. So when people sense that something is wrong, that every shock leaves them further behind even when the headlines say recovery, they are not imagining it. They are experiencing the stress response of a system designed to preserve itself by concentrating power where it already resides. The cracks are not appearing at the edges. They are appearing at the center, where repeated stress has turned emergency measures into permanent architecture. Once you understand how this system operates inside a single country, the global picture becomes disturbingly clear. The same mechanisms that concentrate wealth domestically also organize power internationally. Capital does not recognize borders the way labor does, and that asymmetry defines the modern world order. At the global level, money flows towards safety, liquidity, and credibility. Countries that issue trusted currencies can borrow cheaply, run persistent deficits, and absorb shocks without immediate collapse. Countries that do not must earn foreign currency through exports, tourism, or resource extraction just to service debt. This creates a hierarchy of monetary privilege. Some nations finance themselves by issuing promises. Others must pay real economic costs to obtain those promises. When global interest rates rise, the imbalance becomes brutal. Capital retreats to the center. Emerging markets face currency depreciation, higher debt servicing costs, and capital flight. To stabilize, they raise rates, cut spending, and impose austerity. Growth slows, employment suffers, social tension rises. The adjustment burden falls on workers and households, not on global capital, which has already moved on. This is not theoretical. It has repeated across Latin America, Asia, Africa, and parts of Eastern Europe for decades. Financial crises often arrive framed as local failures, corruption, mismanagement, lack of discipline. But the underlying structure is consistent. Borrowing in a currency you do not control while operating inside a system that prioritizes capital mobility over domestic stability. Trade deepens the pattern. Global supply chains reward efficiency, not resilience. Corporations shift production to where labor is cheapest and regulations are weakest. Wages are suppressed in high-income countries by offshoring threats, while workers in low-income countries remain trapped in low-margin competition. Value accrues at the top of the chain: intellectual property, branding, finance, while labor-intensive stages are interchangeable and disposable. Even technological progress follows this logic. Automation and digitization increase productivity, but the gains flow to owners of platforms, data, and capital. Workers face displacement or downward pressure on wages. Nations that control technology standards, financial infrastructure, and capital markets capture outsized returns. Those that do not become dependent users. Global crises accelerate everything. During financial shocks, capital floods into safe assets issued by powerful states. Their borrowing costs fall precisely when others spike. During pandemics, supply disruptions raise prices globally, but firms with pricing power protect margins. During geopolitical instability, commodity exporters face volatility, while financial centers monetize uncertainty. The result is a world that appears interconnected but behaves hierarchically. Capital moves freely. Labor does not. Wealth compounds in places with credibility and control. Adjustment costs are pushed outward, onto populations with the least flexibility. This has political consequences. Governments constrained by debt and capital flight lose policy autonomy. Social programs shrink. Infrastructure decays. Populations grow resentful, not just of domestic elites, but of a system that seems rigged against them. Populism rises. Trust erodes. Stability weakens. At the same time, countries at the center face a different tension. Asset prices soar. Inequality widens. Political systems strain under the weight of concentrated wealth. Democratic legitimacy erodes as policy appears increasingly disconnected from lived experience. The same forces that destabilize the periphery hollow out the core. This is why global inequality is not a side effect of development stages. It is the predictable outcome of a system that prioritizes capital preservation, asset stability, and monetary hierarchy. The winners are not simply richer countries. They are countries positioned to issue, attract, and protect capital. The losers are those forced to adjust to decisions made elsewhere. Understanding this reframes global debates. Development is not just about education or governance. It is about position within a financial architecture that rewards ownership, credibility, and control. Until that architecture changes, growth alone will not close the gap. It will often widen it. And that leads to the final question. If this system keeps concentrating power, what happens when its social and political limits are reached? At this point, the pattern should be uncomfortable, but unmistakable. Wealth concentrates not because people suddenly became less virtuous or less intelligent, but because the system is structurally aligned to reward ownership, leverage, and patience while penalizing reliance on labor alone. The danger is not that this is unfair. The danger is that it is unstable. History gives us a clear warning here. Extreme inequality does not persist indefinitely without consequence. When too much wealth and power accumulate at the top, systems begin to fail in ways that spreadsheets cannot predict. Social trust erodes. Political legitimacy weakens. Productivity gains slow because broad participation disappears. Eventually, the system that protected capital begins to threaten it. What makes the current moment different is speed. Financialization, digital markets, and global capital mobility allow wealth to concentrate faster than ever before. At the same time, workers face rising costs of housing, healthcare, and education, with fewer buffers and weaker institutions. That combination produces a quiet pressure cooker. People may not understand the mechanisms, but they feel the outcome in their daily lives. The most common response to this realization is despair or cynicism. But that reaction misses the real lesson. Systems are not laws of nature. They are sets of rules created, adjusted, and defended by people with power. And history shows that the only times extreme inequality reversed were moments when those rules were forced to change. The labor movements of the early 20th century. The reforms of the New Deal era, the post-war economic settlement. None of these emerged from goodwill. They emerged from pressure. There is also a personal implication that is uncomfortable but necessary. You cannot outwork a system designed to extract your productivity. Effort matters, but position matters more. Ownership matters more. Understanding how money flows matters more. This does not guarantee success, but ignorance guarantees vulnerability. The future will likely not arrive as a clean break. It will arrive through stress, another crisis, another shock, another moment where emergency responses once again protect assets first. Each time, the gap will widen unless something interrupts the pattern. That interruption could be reform. It could be backlash. It could be instability. History offers multiple paths, none of them painless. The quiet warning is this: a system that concentrates wealth indefinitely undermines the very stability it claims to protect. When too many people feel locked out, the question stops being how to make the system fairer and becomes how long it can hold. Understanding this is not about resentment. It is about clarity. Because once you see the machine for what it is, you stop blaming yourself for outcomes that were never fully under your control. And more importantly, you stop mistaking inevitability for design. If this analysis helped you see the system more clearly, stay with me. These patterns repeat across history, across countries, and across crises. And the more clearly we see them, the harder they are to ignore.